Chairman and CEO Lance Fritz joins us now to discuss the quarter and more. Lance, great to have you on today. To keep the thread going from what Jane just reported on the Mississippi, BMO recently putting out a note on this, that this disrupted grain movement, given what we're seeing with the river levels, that it could be an opportunity for a company such as yours. Are you seeing some of those flows actually transfer to the rail right now?
Yeah, Morgan, good morning, and thank you for hosting me. Yeah, we are seeing some demand shift. We typically transport grain to the river in the northern portions of the Mississippi so that it can get on the river and go down south. And a lot of those movements now are coming to us and wanting to go south on our railroad all the way down to the Gulf. So it's an opportunity. It's not necessarily a carload opportunity so much as it's a length of haul opportunity. And yeah, we are seeing it. We're trying to take advantage of that to help our customers.
Okay, so let's talk a little bit about the quarter. At a time where everybody's trying to read the tea leaves on the state of the economy right now, you're trimming your annual volume forecast. Despite rising shipments last quarter, I might add. Why?
Yeah, great question. So let's focus in on the quarter. The quarter was a noisy quarter. We had a labor adjustment for the labor negotiations that are in the process right now coming out of the PEB. And what we essentially did was we had sequential improvement operationally. That supported more volume, and we also had strong fuel surcharge and good pricing. So that supported our financial metrics, records in net income and et cetera, et cetera. As we look into the fourth quarter, what we shared was we still see growth. We just don't see quite as much growth as we had expected at the start of the third quarter. Those issues are, the consumer slowing down. We're seeing that in both they're purchasing more experience, fewer goods, and overall they're concerned. And so we're seeing, there's a little pressure on the domestic intermodal side, on the parcel side, but there are some markets that are still very strong for us. Coal's good, grain's good, rock's good, infrastructure. So it's kind of a mixed bag, but overall we see the heat coming out of the market.
Okay, so just to dig into that a little bit more, our own Lorianne LaRocco here at CNBC is reporting that you're seeing container shipments coming out of China, for example, falling off a cliff. But then on the other side of the equation here, the fact that we've seen a lot of those flows, those cargo shipments divert away from the West Coast to the East Coast, given things like congestion and labor strike concerns at the ports there. So how much of, when you talk about a softening consumer, how much of this is, from your standpoint, company and geography specific? How much of it speaks to the broader economy?
Yeah, it's a great question. So the moving parts for us when we think about international intermodal, that's a container coming from a supplier in Asia, hits the West Coast, and then some portion of that is given to us to bring by rail into the interstates. That percentage had dropped dramatically earlier this year. The percentage of international containers that shippers give to us to move by rail, as opposed to transloading them into truck or a domestic container and then moving them in. As that has recovered, that's kind of covered up, if you will, some of the softening of overall inbound containers dropping. And those moving parts are going to continue to play into the fourth quarter and next year. So exactly what our international intermodal business looks like is going to be driven by those two things. Containers are dropping inbound numbers into the West Coast ports, but the percent of those that are being given to us as a railroad to move inland has been increasing. And we'll just have to see how that plays out.